Yeah, absolutely. Look, I think we've had a tremendous run since March 23rd, really, up nearly 42% since last Thursday. Since mid-May, we've really been driven by that cyclical trade, as Mike alluded to. Really, the reopening story, the additional mobility we're seeing, the better economic data on the margin has been driving this cyclical story. And I think at some point we did get a little too far too fast. We did cross that 3,000 threshold very abruptly, move up very quickly. And so I think we were due for a period of consolidation. But what's important to keep in mind is every time now that we have gotten periods of consolidation, there are investors on the sideline, both institutional and retail, that have excess or elevated levels of cash. And so they are playing a catch-up trade here. They are working hard to keep their performance now in line with the major indices. And so perhaps going forward, we'll see this pattern a bit more often. Now, of course, we'll be watching to see, of course, how the virus trends play out. But as you noted, we are facing potentially better health outcomes from better therapies and vaccinations, potentially more stimulus on the horizon, and of course, that ongoing support from the Fed as well.
That's what I was going to ask you, Mona. On down days, we would have been talking about, did you see the Florida case numbers and hospitalizations that came out today? I mean, there's still this sort of persistent spread of the virus in certain hotspots that make you wonder about a V-shaped recovery. Where is the market? Where are you guys on that?
Yeah, broadly speaking, we certainly expect on a regional basis there to be flare-ups and hotspots of coronavirus still. We have in the U.S. on average still 20,000 cases on a daily basis. Hospitalizations, as you noted, which are a better metric than probably cases, have been rising in certain areas. But we don't expect another shutdown of the entire U.S. economy. And of course, keep in mind, these outbreaks will be dealt with more on a regional basis. There's even more pressure on the states to keep the economies open. Hopefully, the therapies that we're seeing come into play help keep that pressure off the hospital systems. I think today's drug in particular talked about a reduced number of days on ventilators, et cetera. So I think therapies will certainly help with that as well. Also, keep in mind the epicenter of the crisis here in the U.S., New York and New Jersey in particular, have been seeing ongoing better trends generally. So while we are undertaking this reopening process, I think the flare-ups and hotspots will be natural, but don't expect the worst case scenario like we saw back in March.
Well, let's just briefly hit pause on the broader market discussion. Oracle numbers are out. Josh Lipton has them for us.
That's right, Will. So Oracle reporting Q4 EPS here of $1.20. The street was closer to $1.15. Revenue, though, comes in a bit lighter than expected, $10.44 billion in the quarter. Street was at $10.65 billion. Cloud services and license support, that comes in at $6.85 billion. That's a bit lighter than what analysts have been looking for. That includes cloud revenue and maintenance fees for traditional software. Cloud license and on-premise license, that's also a bit lighter at $2 billion. Hardware a bit better at $901 million. In a statement here, Oracle CEO Safra Catz saying that overall business, she says, did remarkably well considering the pandemic, but our results, she says, would have been even better except for customers in the hardest hit industries, she says, that they serve, such as she calls out hospitality, retail, and transportation. She says postponing some of their purchases. Heading into this print, the stock had been on a decent run. It was up about 30% in the past 3 months, though still underperforming the broader tech sector. This conference call kicks off at 5 p.m. Eastern, and we'll be on it. Guys, back to you.
Josh, thanks so much for that. Steve Weiss, you said you're very heavy into tech. Is Oracle one of them?
No, Oracle didn't need a pandemic to miss. They're a serial misser. They're very tied to GDP. The stock's not where it was, even though the big recovery. And before COVID, it had been down from its 2019 high. I'm in more growth companies that are less tied to GDP. As I mentioned, the cloud, 5G, that's where I think you will get rewarded for owning those stocks. A little more volatility than Oracle, but, Oracle trades like a flat line most of the time. But I think well worth owning for the volatility.